I often wonder what Benjamin Graham would think if he could see today's markets. A world where prices change by the millisecond, where millions chase profit through screens, and where silence has become unbearable. The hum of activity never stops. Portfolios adjusted by algorithms, traders reacting to tweets, investors measuring success by hours instead of years. Everywhere you look, motion is celebrated. We are told that to succeed, we must always be doing something. Buying, selling, predicting, reacting. Patience, in this age, feels almost foolish. But Graham would have disagreed. He believed that in the market, as in life, movement without purpose is not progress, it's noise. To him, the difference between an investor and a speculator wasn't about intelligence, but temperament. The investor is calm, deliberate, and anchored by reason. The speculator, though often clever, is a prisoner of emotion, restless, impulsive, unable to wait. Graham once observed that the investor's worst enemy is likely to be himself. He meant that our own impatience, not the market, often destroys our wealth. When we study his writings today, The Intelligent Investor, or Security Analysis, we find not just financial instruction, but a philosophy of stillness in a world of chaos. He taught that the greatest opportunities are not found in constant motion, but in understanding when to move and when to stay still. And this idea didn't come from theory. It was born from experience, from triumph, disaster, and decades of observing the market's moods. Because before Graham became the father of value investing, he was a young man standing on the floor of Wall Street, watching a world intoxicated by speed. And in that world of feverish speculation, he learned his first and most enduring lesson, that patience, not activity, is the true foundation of wealth. But how did he come to believe this? To understand that, we must return to where it all began, to the early life of Benjamin Graham. Benjamin Graham was born in London in 1894, but his story truly begins in New York City. His family moved there when he was just a year old. His father ran a small business importing fine china, elegant, fragile, and entirely dependent on the prosperity of others. When Benjamin was still a boy, tragedy struck. His father died suddenly, and the family, once comfortable, was thrust into poverty. Graham would later recall how his mother tried to maintain appearances, even renting out part of their home to make ends meet. He remembered the humiliation of scarcity, of watching wealth evaporate overnight. These early experiences left a permanent mark on him. They taught him that fortune could be fleeting, and that survival depended not on speed, but on prudence. In his teenage years, his brilliance opened doors. He won a scholarship to Columbia University, graduating second in his class, just behind a future Nobel laureate. Yet he chose not to pursue a life in academia, but Wall Street. It was 1914, and America was on the edge of modern finance. Stocks were becoming a national obsession, and fortunes were made and lost in moments. At first, he was swept up in it. He was ambitious, curious, and eager to learn. He became an analyst, then a partner at a brokerage firm, excelling at research and uncovering mispriced securities. But as markets boomed through the 1920s, he noticed something unsettling. Investors were no longer thinking, they were reacting. They confused price with value, speed with skill. And Graham, despite his growing success, began to feel uneasy. He once described that period as a great speculative orgy. It was a time when every conversation seemed to turn toward stock tips, when paper profits made even ordinary people feel invincible. The faster one moved, the richer one became, until 1929, when everything came crashing down.
That year changed Benjamin Graham forever. He watched his personal fortune and his clients collapse almost overnight. Companies once thought indestructible vanished. Investors who had traded feverishly were left broken. And from the wreckage, Graham drew one of his most profound insights. The market rewards patience, not activity. He realized that during the frenzy, those who waited for real value, those who resisted the urge to act on every tick of the market, were the ones who survived. That realization would form the cornerstone of his philosophy. But it wasn't yet fully formed. The young Graham still had questions, and one of them was this: if patience is so powerful, how can one practice it in a world addicted to motion? The answer would emerge in the decades that followed, as Graham rebuilt his fortune and reshaped the way the world thought about investing. But to understand the full depth of his thinking, we must first explore the chaos that shaped his most enduring wisdom. Because the years that followed, the Great Depression, would test the patience of even the most disciplined investor. And Graham was about to learn just how difficult it is to stay still when the world is falling apart. When the stock market crashed in 1929, the roar of Wall Street turned into silence. The ticker tapes stopped printing numbers that made sense. Once booming companies were reduced to rubble, and those who had borrowed to buy stocks on margin faced ruin. For Benjamin Graham, it was more than a financial collapse. It was a philosophical awakening. He had lived through prosperity and panic, through a market that promised everything and then took it all away. He saw firsthand how investors' greatest enemy wasn't the crash itself, it was their reaction to it. Panic, fear, the desperate need to do something. These impulses drove people to sell at the worst possible moments, to destroy what little remained of their capital. But Graham did something extraordinary. He didn't rush to act. He stopped, observed, and reflected. He realized that the path to recovery did not lie in movement, but in discipline. While others flailed in chaos, he began to study the nature of value itself. He asked, what makes a business truly worth something? How can we know when the market's price is wrong? And most importantly, how can we protect ourselves when emotion takes over reason? These questions led him to one of his most revolutionary ideas: that stocks are not numbers on a screen, but ownership in real businesses. And those businesses have an intrinsic value, a worth that exists independent of market moods. So while others were obsessed with price fluctuations, Graham started looking at financial statements, balance sheets, and earnings. He discovered that many solid companies were selling for far less than their actual value, simply because the market was too afraid to see their potential. He began buying them quietly, methodically, when others could not bear to. One of his favorite examples was the Northern Pipeline Company, a solid business trading for less than the cash it held. Graham invested heavily, not because the market said it was time, but because patience told him value was there. Over time, this discipline transformed into a framework: value investing, an approach rooted in analysis, not emotion. Graham's patience was not passive, it was active waiting. It was the art of being prepared, doing the work, and acting only when opportunity was unmistakable. As the economy slowly recovered, his method proved astonishingly effective. While speculators tried to predict the next swing, Graham's quiet, deliberate strategy rebuilt his fortune and reputation. He had learned that markets are like waves, powerful but temporary. You cannot control their motion, but you can control your reaction. The investor's job is not to chase every swell, but to wait for the right tide.
And as the 1930s gave way to new decades of change, Graham's philosophy of patience over activity would soon find its purest form in his concept of the margin of safety. But before that idea was born, Graham had to understand something even deeper: why human beings, time and again, prefer action over wisdom. And that insight would come not from the market, but from the mirror. Benjamin Graham often said, "The investor's chief problem, and even his worst enemy, is likely to be himself." It's a line that still feels unsettlingly true today, because the greatest obstacle to patient investing isn't volatility, inflation, or even bad advice. It's human nature. Graham came to this realization not from academic study, but from years of watching people, brilliant, educated people, destroy their own wealth simply because they couldn't bear to be still. He saw the same story play out again and again. When prices rose, they wanted more. When prices fell, they couldn't stand the pain. They mistook motion for control. In truth, the stock market preys on this impulse. It tempts us with the illusion of power, the idea that if we just do something, we can predict or prevent what's coming. But Graham knew the truth. The more we tried to control the market, the more it controls us. During the Depression years, he would observe how even seasoned investors couldn't stop tinkering with their portfolios. They sold strong companies in fear, then chased others in hope. Yet the patient investor, the one who sat quietly, studied, and waited, often emerged wealthier. Why? Because patience isn't the absence of action. It's the mastery of timing. It's the same principle a farmer understands. You don't grow crops by digging up the soil every hour to check the roots. You plant carefully, water consistently, and wait. The harvest rewards patience, not impatience. Graham saw investing the same way. A well-researched purchase, bought with a margin of safety, needed time to grow. Time for markets to correct their irrational prices. Time for businesses to realize their potential. But modern investors, even in his day, couldn't wait for the seasons to change. He used to joke that Wall Street was the only place where people ride to work in a Rolls-Royce to take advice from those who arrive by subway. His humor masked a serious truth. Most people were driven by emotion, not analysis. Graham's teaching was radical because it demanded restraint. It asked investors to do the hardest thing of all, nothing, when nothing was the right thing to do. He understood that inactivity requires strength, because in a world obsessed with noise, stillness feels like failure. But Graham proved it wasn't. Stillness was the foundation of clarity, and clarity in investing is worth more than gold. This belief would eventually shape his most enduring lesson, that success in markets has far less to do with brilliance and far more to do with temperament. And nowhere would this lesson shine more clearly than in the contrast between two kinds of investors he defined: the defensive investor and the enterprising investor. Both sought success, but only one truly understood the virtue of patience. Benjamin Graham believed that every investor must first understand who they are before they decide what to do. In his eyes, there were two tribes in the world of investing: the defensive investor and the enterprising investor. The defensive investor was not weak, as the name might suggest. In fact, they were strong in a way most people are not. Disciplined, deliberate, content with steady returns, and fiercely protective of their capital. They sought safety, not excitement. They preferred to own solid, established businesses bought at reasonable prices. Graham saw patience as the defensive investor's greatest weapon. To them, inactivity wasn't neglect, it was wisdom. They understood that the best way to grow wealth was not to chase opportunity, but to avoid ruin. As Graham would say, the essence of investment management is the management of risks, not the management of returns.
Then there was the enterprising investor, more active, curious, and willing to dig deep for undervalued opportunities. They weren't reckless, they were analytical. But even for them, Graham imposed one condition: their activity must be intelligent, not impulsive; research, not reaction; strategy, not speculation. To Graham, what separated these two types wasn't intelligence, it was temperament. The defensive investor could wait for years without changing course, While the enterprising investor used their energy to find rare gems others overlooked. Both paths worked, as long as they respected the same law. Patience must guide action. He warned that the moment an investor begins to trade out of boredom or fear, they stop being investors and become speculators, gamblers in disguise. Think of today's world. Apps that allow trading with a single tap, social media feeds filled with hot stock picks, and headlines that scream urgency every minute. Graham would likely smile and shake his head. He'd remind us that real wealth doesn't come from doing more, it comes from doing better. He'd point to the quiet investor who holds a sound stock through decades of noise, collecting dividends and sleeping peacefully, while others chase trends and lose sleep. In Graham's philosophy, patience is not passive, it's purposeful restraint. It's knowing when to step back so that time can work for you, not against you. And this discipline, when combined with a deep understanding of value, created what Graham called the margin of safety, the ultimate expression of patient investing. But before we explore that cornerstone of his philosophy, it's worth asking, why does patience feel so unnatural? Why is it so hard to simply hold on even when we know we should? To answer that, we have to look at what Graham saw so clearly, that markets are not ruled by logic, but by emotion, and that the true battle for patience is fought not in the market, but in the mind. Benjamin Graham understood that investing was not just an economic activity, it was a psychological struggle. The market, he observed, is a stage where two primal forces, fear and greed, perform endlessly. And investors, whether they realize it or not, are often the audience and the actors at once. He wrote, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." Those words carry profound wisdom. In the short term, prices reflect popularity, what people feel. But over time, reality prevails. Businesses are weighed by their true results, not by sentiment. And yet most investors cannot resist the voting machine. They are pulled by excitement when prices rise and panic when they fall. Graham saw this clearly during his lifetime, from the roaring 1920s to the post-war booms and busts. He noticed that the crowd always followed emotion, not reason. He used to describe the market as a moody business partner named Mr. Market, a man who shows up at your door every day offering to buy or sell shares of your business. Some days, Mr. Market is euphoric and offers you ridiculous prices. Other days, he's depressed and practically gives things away. Your job, Graham said, was to take advantage of his moods, not share them. That simple parable revealed the secret of patience. You don't have to respond to every offer the market makes. You can wait for the right one. But the human mind struggles with waiting. We are wired to react, to do something. When our portfolios dip, our hearts race. When prices surge, we feel left behind. The very biology that once helped our ancestors survive now works against us in the market. Graham's genius was that he offered a rational structure to protect investors from their impulses. The margin of safety, intrinsic value, diversification, these weren't just analytical tools, they were psychological shields. He knew that the calm investor would always outperform the restless one, because when fear spreads, the patient investor buys quality assets cheaply, and when greed takes over, the patient investor sells them dearly.
Even in modern markets dominated by algorithms and data, this truth hasn't changed. Machines may execute trades faster than humans, but they still reflect human emotion, programmed through bias, momentum, and overconfidence. In essence, Graham's timeless message is this: markets will always fluctuate, but our reaction to them determines our fate. And so, as he refined his philosophy through the 1930s and 1940s, he discovered a principle that turned patience into measurable protection, the margin of safety. It was the bridge between reason and security, between action and restraint, and it became the foundation upon which all intelligent investing would rest. For Benjamin Graham, patience was never about sitting idle. It was about waiting intelligently. And the key to waiting intelligently was what he called the margin of safety. At its heart, the margin of safety is a simple idea. Never buy a stock for what you think it's worth. Buy it for less. That difference, that cushion, protects you from mistakes, bad luck, and the unpredictable moods of the market. Graham understood that no analysis is perfect. The future is uncertain, and human judgment is flawed. So instead of pretending to be infallible, he built humility into his strategy. If a stock's true value was $100, he might only buy it at $70 or less. That 30% gap was his margin of safety, a barrier between reason and ruin. This principle reflected more than just financial caution. It was Graham's philosophy of patience made tangible. Because finding opportunities with a margin of safety required time. Time to study, to calculate, to wait for the market to offer the right price. It meant resisting the urge to act when the numbers didn't make sense, and trusting that value would eventually reveal itself. He often compared it to engineering. A bridge built to carry 10 tons must be strong enough to hold 30. The same logic applies to investing. You must assume that unexpected pressures will test your structure, and only a margin safety can prevent collapse. Graham's greatest investments followed this principle. He bought companies trading below the value of their assets or even below the cash they held. They were unpopular, ignored, and often boring, precisely why they were undervalued. And yet, when the market eventually recognized their worth, the returns were extraordinary. This approach required patience not only to wait for the right opportunities, but to endure the silence that followed. Months, even years, could pass before prices corrected. But Graham didn't mind. He understood that time is the friend of the patient investor and the enemy of the restless one. It's tempting to think that such patience no longer applies in our modern hyperactive world, but it does, perhaps more than ever. In a market ruled by algorithms, where thousands of trades happen in milliseconds, true patience has become the ultimate edge. While others chase momentum, the patient investor quietly builds wealth. They understand that the market's noise eventually fades, but value endures. The margin of safety is not just a financial concept, it's a mindset. It teaches us to prepare for uncertainty, to accept imperfection, and to trust in the power of time. And that mindset would influence not just Graham's own success, but an entire generation of investors, including one young student who would take his lessons and build one of the greatest fortunes in history. That student's name was Warren Buffett, and his story is proof that patience, properly understood, can turn ordinary wisdom into extraordinary wealth.
Graham spoke softly, but with conviction. He didn't promise quick riches or insider secrets. Instead, he spoke of temperament, logic, and discipline. He told his students that investing success wasn't about predicting the next boom. It was about surviving the next bust. Buffett was captivated. Years later, he would say, "I'm 85% Benjamin Graham." He devoured The Intelligent Investor, which Graham called by far the best book on investing ever written. But more than the formulas or balance sheets, Buffett absorbed the spirit of Graham's teaching, the calm, methodical patience that saw opportunity not in chaos, but in misjudgment. After graduating, Buffett was so eager to work under Graham that he offered to do it for free. At first, Graham declined, but eventually, Buffett joined the Graham-Newman Partnership in New York. There he watched his mentor put theory into practice. Graham's methods were deceptively simple. Find undervalued stocks, buy them, and wait. Sometimes these were companies everyone else had written off: dying textile firms, sleepy manufacturers, overlooked retailers. But Graham wasn't buying their stories, he was buying their numbers. He calculated their intrinsic value and waited for the market to correct its error. For Buffett, this was revelation. It wasn't glamour. It wasn't luck. It was patience weaponized. In the years that followed, Buffett refined Graham's ideas. He began to realize that patience wasn't just about waiting for prices to recover. It was about waiting for the right kind of company. Under the influence of another mentor, Charlie Munger, he shifted toward buying great businesses at fair prices instead of fair businesses at great prices. But even then, Graham's foundation remained: the margin of safety, the refusal to speculate, the calm observation of Mr. Market, and above all, patience. Warren Buffett once described the market as a mechanism that transfers money from the impatient to the patient. It was a perfect echo of his teacher's philosophy. When Buffett bought shares of Coca-Cola in 1988, the world thought he was too late. The stock had already risen sharply. Yet Buffett saw long-term value and held on to it, not for months, but for decades. His patience turned billions into tens of billions. Each of these decisions, each act of restraint and conviction, traced back to those quiet days in Graham's classroom, where a young man learned that waiting could be more powerful than rushing. Benjamin Graham taught Warren Buffett how to think. And through Buffett, Graham's philosophy found immortality, living on in every investor who chooses reason over reaction, value over vanity, patience over panic. But Graham's lessons didn't end with his students. His ideas would go on to shape an entire generation of thinkers who saw markets not as casinos, but as classrooms, places to learn about human nature, emotion, and discipline. And that brings us to perhaps the most profound aspect of Graham's legacy: the timeless psychology of patience. Patience, it sounds simple, but in the market, it is the rarest of virtues. Benjamin Graham understood this deeply. He once said, "The investor's chief problem, and even his worst enemy, is likely to be himself." That single line captures a truth that even today's most advanced algorithms cannot escape. Investing is not just about analysis, it's about emotion. Think of what happens in moments of frenzy. Prices soar, headlines scream, and the crowd rushes in. The temptation to act, to do something, is overwhelming. We see others getting rich and fear being left behind. And yet this is the very moment when Graham's voice echoes the loudest: be fearful when others are greedy. That's not just Buffett's adaptation. It's pure Grahamian psychology. In Graham's time, the same patterns repeated themselves. In the Roaring '20s, everyone believed the market could only go up. Taxi drivers, shoe shiners, and teachers all bought stocks on margin. The idea of risk had vanished. And then came 1929.
In the aftermath of that crash, Graham realized something profound. The greatest losses didn't come from ignorance. They came from impatience, from the human need to chase, to predict, to act. He understood that successful investing wasn't about having superior intelligence. It was about having superior self-control. Fast forward to today. The faces have changed. The tools have evolved, but the psychology remains identical. Now, the crowd gathers on social media instead of the stock exchange floor. The noise is constant: predictions, charts, memes, hype. And yet, Graham's timeless wisdom still cuts through. The intelligent investor does not react, he reflects. He doesn't trade to feel busy, he studies to feel calm. Patience is not passive, it is an active discipline. the act of saying no more often than yes. It's about sitting through boredom, resisting excitement, and trusting the process of compounding. Consider this. If you invested $1,000 and doubled it every year for 10 years, you'd have $1,024,000. But that kind of compounding doesn't happen through constant trading. It happens through staying put when it matters. And yet, the hardest thing for most investors is to do nothing. Graham used to joke that Wall Street was the only place where people rode in Rolls-Royces to get advice from those who took the subway. What he meant was this: wealth and wisdom are not the same thing. The patient investor knows when to act, but more importantly, when not to. He reminded us that time is the greatest ally of the intelligent investor and the deadliest enemy of the impatient speculator. So when markets fall, or when everyone else seems to be winning faster, remember Graham's greatest unspoken rule. In the long run, the calm mind always wins. And yet, even Graham himself would face the challenge of proving this patience one last time, not in theory, but in practice. Because toward the end of his life, as markets changed and new trends emerged, he began to question whether his methods would still work in the modern world. And the answer he found would reveal the most human and perhaps the most powerful lesson of all. As Benjamin Graham grew older, he observed the world around him change at an ever-accelerating pace. New markets emerged, technologies reshaped industries, and investors clamored for instant results. Yet, through all of it, his principles remained steadfast. He realized that the markets would always be chaotic, unpredictable, and emotional. They would reward impatience in the short term and punish it in the long term. But for the disciplined investor, the lessons of decades remained relevant. Buy with a margin of safety, understand the intrinsic value, and above all, exercise patience. Graham often reminded his students, and through them, generations of investors, that success in investing is more about character than intellect. A brilliant mind can be destroyed by impatience. An ordinary mind, guided by patience, can grow into extraordinary wealth. The greatest investors he inspired, from Warren Buffett to countless others, proved this truth over and over. They built fortunes not by chasing the crowd or the latest fad, but by waiting for opportunities, acting with reason, and letting time work in their favor. In the quiet of his office, surrounded by financial statements and reports, Graham would reflect on what really mattered. He understood that the world is impermanent, but sound principles endure. The market's noise is fleeting, but discipline, analysis, and patience echo across generations. And that, perhaps, is his most profound legacy. Patience isn't merely a tool for wealth. It is a philosophy of life. It teaches restraint, reflection, and the courage to trust the slow unfolding of truth. So as you navigate the markets today, remember Graham's timeless counsel. The urge to act can be powerful, but the wisdom to wait is priceless. Protect your capital, know your value, and never let the frenzy of the world dictate your choices. Because in the Graham way to wealth, time is the ultimate partner. The market may swing wildly, fortunes may rise and fall, but those who act with patience, clarity, and discipline will endure. And in the end, that is the quiet power of waiting, a power Benjamin Graham understood, lived, and taught, leaving a legacy that whispers across the decades. Patience beats activity every time.